Today's podcast is with Mike Palm, partner and managing director of Charter Capital. Mike brings over 20 years of experience in finance and investing to his role as partner. He oversees the firm's day-to-day operations and serves on the investment committee. Mike leverages his deep private equity background to source, structure, and close investments while also providing strategic guidance to portfolio companies as they grow after joining their portfolio. Before joining Charter Capital, Mike was vice president at Dry House Private Equity in Chicago, and he was also an associate at Beacon Petty O'Keefe & Company, a middle-market private equity firm focused on healthcare services. He's a native of Grand Rapids and now lives in East Grand Rapids with his wife, 2 children, and their relatively reliable retriever, Ella.
Welcome to the Navigating Abundance podcast. Our goal is to encourage you to pursue your total family wealth potential through insightful conversation with experts and thought leaders in their fields. But first, some obligatory disclosures. Navigating Abundance podcasts do not represent investment, legal, or tax advice. Any opinion expressed in Navigating Abundance podcast is solely those of Christopher Tanke and his guests and are based upon information believed to be reliable but not guaranteed. Podcasts are produced for educational and entertainment purposes only and should not be considered an endorsement of the guest or the views that they hold. Information shared may not be appropriate for your personal situation. Consult a qualified advisor for guidance. Investment advisory services are offered through Strategic Financial Group, LLC, a registered investment advisor. Navigating Abundance is a trademark of Strategic Financial Group, LLC. And now here's your host, Chris Tanke.
Welcome back to Navigating Abundance. This is Chris Tanke, and I am so excited to have with us as a guest Mike Palm of Charter Capital right in the Grand Rapids area. And we have mutual professional acquaintances, and that's how we got to know Mike over lunch a month or so ago. And really exciting to see what they've built out over there. And the topic of today is really to understand a little bit more about private equity and how that might take place within a portfolio. If you are blessed to have abundance, a lot of folks consider this as a portion of their portfolio. We're going to talk about the ins and outs of that, sort of like a crash course. So, Mike, you'll be gentle with us when we talk about that, right?
Yes, there's so much to cover, and it's effectively an entire asset class. So, I mean, there's way too much to ever cover in a quick podcast. But thank you very much for having me. It's great to be on, and happy to answer questions. This is kind of a mystifying area of the investing space. They're always happy to talk about.
For sure. So thank you. We look forward to you getting us up to speed a little bit on it. But first, let's talk about Charter Capital. There is an advisory branch, so to speak, and there's an investment branch. Could you juxtapose those two things? What does Charter Capital offer people?
So Charter Capital overall is a merchant bank. We're based in Grand Rapids, Michigan. We've been around since 1989. The merchant bank name comes from the fact that it's both an investment bank that does buy-side, sell-side, M&A advisory work, but then also invests capital as well. Merchant banking models go back, literally hundreds of years. They're not are maybe as popular in this day and age, but there's a number of firms that still operate in this kind of part of the space. Our M&A advisory side of the house goes to market as Charter Capital Partners. They specialize in mostly sell-side M&A advisory work, but then also do some buy-side, usually enterprise values of companies between $20 and $200 million. And they do that across the country. Even though we're based in Grand Rapids and we have a number of clients around the state of Michigan or just relatively local to us, we still do have clients. In fact, I believe they've got a deal that's closing tomorrow. So that's geography is not as much of a focus point over there. On the investing side, we go to market as Charter Growth Capital. Charter Growth Capital is a mezzanine debt and equity investor, again, based in Grand Rapids, Michigan, but we try to focus around the Great Lakes states. So we call the Great Lakes states anywhere from on the west side, Minnesota to Wisconsin, Illinois, Indiana, Michigan, of course, Ohio, Pennsylvania, and then upstate New York. And so we try to focus our investments around those areas because when we have businesses that are close to us, we can be most helpful to those businesses to help them grow. And that strategy, again, is a mezzanine debt and equity investing strategy. So we lead with mezzanine debt, which is subordinated debt. If you think about it, is it as if you would have, say, a second mortgage on your house or something. You've got your first position mortgage, and then you'd have a second mortgage, for instance, that although that's not as common in a house, it is very common in the realm of corporate finance. So that's where we sit.
All right. And does Charter Capital, do they have access to financing, access to resources? Do they connect, or are they just advising on that part?
So they will access financing sources, but predominantly they're working with the client which is usually a business or a family that owns a business, and they're looking to go to market, or they at least want to understand what the market could look like if they were to try to sell the business or recapitalize the business. Or also very possibly that someone's reached out to them. ABC Private Equity, like many of them do, has called or emailed, usually pretty relentlessly, borderline annoyingly, to say, hey, Joe, Jane, Phil, Roberta, do you want to sell your company? And if they start lobbing numbers out, it is the American way to say, well, let's talk some turkey. So if there is someone that's doing their organization or a group, or there's some curiosity, talking to an investment banker or an advisor is the first step. We'll take a look at your financials, come up with some valuation ideas. For simplicity's sake, this is all free. All that advising on the front end is just understanding the fit, and if there's a willingness when they go to market or try to get a deal done.
Yeah. Wow. Very good. Very good. All right. But you, of course, are on the side that takes a lot more gray matter, the investment side, all of that research that you're doing and whatnot. Describe to us a little bit about Charter Growth Fund, what it might offer to people. Kind of take us through the paces of that.
Yes. So Charter Growth Capital, what it offers to people can be different types of people, two predominantly. We have our limited partners who are the investors that invest in the fund. And so those are, to your point earlier, about people with abundance or high net worth investors, but also institutions, also banks, even large, government, investors and whatnot as well. And so that's the LP, the limited partner side of the business. What also it offers would be what it offers to management teams, to individuals trying to buy businesses, and then of course to the companies themselves and their ownership group, as an investor in the business. And so it depends kind of what kind of shoes, an individual might be sitting in. But when we work with, say, if you were going out to go and buy a business, we would partner up with you. You would go and try to write an LOI to sign that business up to be buying it at some specific purchase price. You might go to a bank to get some financing. You might go to some friends and family to find some other equity financing. And then we kind of bridge that gap in the middle. And so we try to be a little bit, we'll do a mix of debt and equity. So not just that mezz debt, that second lien debt that I mentioned before, but then also we'll write a more at-risk check in the equity side of things. And what we bring, to your original point, really is we try to bring more than just capital, but we try to bring resources beyond that, because we invest in a lot of smaller businesses that are going through the same types of growing pains. And so as we learn different ways about how to help with ERP systems, or hiring salespeople, or expanding geographically, or upgrading the management team, we're here to lend our kind of lessons and experience to the team.
And those lessons and experiences you're lending, is that like leading up to the sale? So somebody's buying a more perfect process or perfect system, or do you actually, after the deal is done, you can still, because you're involved with this a little bit, or there's still some skin in the game, so to speak, in a second position or something, you're involved with just making sure that the business that was purchased continues to be really viable. You, as much as they would want, you want to be coaching them or involved with that. Is that true?
Yes, true. So usually on the equity side, if we have an equity investment, we'll have a board seat. So, and that usually helps depending on where the business was before. In most cases, they don't necessarily have an official board of directors, but we start to bring in outside capital providers, and the business changes hands. A board is formalized. This is just kind of part of that professionalization sometimes that occurs when a business may be family owned, founder owned, but when it goes on to either another generation that wants to bring in outside capital to grow, or it's bought by a third party individual or from an investment firm, and we're all backing them to do it, there's kind of a meeting of the minds and resources all together that help put a board together to consider different options and whatnot, like you're talking about.
Yeah, that's probably a pretty difficult transition for a founder who has been the grand poobah, the pope of the whole thing. And now all of a sudden, because other capital comes in, of course, with that capital comes accountability and expectations and matrices and all sorts of things that you have to be meeting now. I imagine that takes some a transitory thought for folks that are involved with that sort of thing.
Yeah, it can, if you're a founder or owner or whatnot. Sometimes, the reason a lot of times founders or families go to consider exit options is, one, they're not sure what it's worth, and then they find out, oh my gosh, really? I didn't realize that that's what I could, get in the marketplace. but also because they start to maybe even get just a little fatigued, where they brought the business through the Great Recession of 15 years ago, or they brought it through COVID, or it's just time to say, you know what, maybe we should figure something else out. Oftentimes it's not a shoo-in that offspring or children are going to dive right into the family business. They might be doing other things. Maybe they went to a different type of schooling, or they moved to a different part of the country. So sometimes people realize that maybe they have to look at other options.
Yeah, exactly right. All right, so I'm somebody who's been blessed with resources. I'm pretty familiar with commercial or democratic investing with mutual funds, ETFs, stocks, bonds, those sorts of things. And I've been wondering about PE. Describe to me what that is and the value that it might have in my portfolio, actually to delve into a little of it.
Yeah, so private equity, again, I'm not a wealth manager, but just my understanding of it, to your point, there's mutual funds and ETFs and advisors and all sorts of products out there. In fact, Wall Street seems to be, we have the ability to create endless streams of products. I mean, anything out there could be a financial product in some sort of way. So what private equity is essentially separate from a lot of investments that have a public angle to it, whether it's a public stock directly, or it's a portfolio of public stocks in a mutual fund or an ETF, or some other unique strategy in a public security sense, whether it's a public bond or not necessarily just a public equity. This is private. So this is private money it's not liquid. This is probably the biggest, most obvious thing, but private money that's invested in businesses around the country. It is one of those things that, simply put, and I don't have the data here to back all this up, but directionally, there's less public companies today than there probably were 30 years ago. I think that is relatively a fact. And so with the complication of becoming a public company, we are seeing the IPO window open a little bit here right now. We're seeing some IPOs come out there. But, back in the 80s or 90s, if you had a business of relatively decent size, it didn't take much for it to go public. It could actually float on the New York Stock Exchange or the NASDAQ or one of the exchanges. In this day and age, a lot of times what we see is, and I'm over kind of glossing over broad strokes of the industry, but effectively private equity, as these private equity funds have allocated capital in different fund vehicles, they actually might buy the company. So in a way, ABC company that's been in West Michigan since, say the 60s or 70s, that maybe could go public, back in the 90s, in this day and age, they might end up getting bought by a private equity firm. That's their route onward, their off-ramp as the family or the founders decide to do something different. Or enable a way to help enable the next generation to come through. That's what private equity effectively is. And private equity, depending on how you want to define it, can mean a lot of different things. It could be any sort of private asset. It could be private real estate. It could be private infrastructure. It could be a private company. Even venture capital itself, of course, in earlier stage companies is a form of private equity. So there's lots of private credit as well as what we do. So there's lots of different ways to kind of, skin the cat, so to speak.
So then do you end up like bundling, almost like a real estate investment trust, a private equity trust or whatever, and you have an offering, and you mentioned as far as illiquidity and stuff, is that how that works? You'll put together a package, say here's a prospectus on this, here's what we anticipate in this, here's the category that we're investing in, here's the timeline, and those sorts of things? Directionally,
yes, but without the clarity of what we're investing in, which is what terrifies some people. Effectively, so if we went out in our fund, we have a $111 million fund, but to raise the fund, we went out to the market to then raise the capital. And so maybe not speaking about offer, I'll just speak about a fund in general. Let's just call it a $100 million fund. But a normal private equity fund, they'll go out, they'll raise $100 million of private limited partner commitments. If Chris is signing on as an LP, you're signing up, there's probably an investor minimum. It might be $250,000 per person, or it might be $100,000. Could be $50,000. It could be $1 million. It's a range, and it's set by the manager. The manager is the general partner, the GP, and the investor is the limited partner, the LP. And you're signing on for your, say, $500,000 commitment over the next 5 years. As part of that $100 million fund, they will draw down your $500,000, make investments in the companies. You're backing them because the team and who they are. You're back in the strategy that they're going to go after. They're going to tell you very explicitly, we're going to invest in these kinds of businesses. We're going to invest in startup businesses that are trying to, come up with some new technology in the agriculture space. If it's a venture fund that is targeting agriculture things, we're going to invest in metal bending and manufacturing businesses that have 2 million of EBITDA or something. If it's a private equity fund that invests in, say, buyouts that are more of a middle of the fairway private equity offering. In knowing what they're going to go invest in, that's what they say they're going to do, and then they go off and actually do it. And so that's where the whole concept of a blind pool comes into play. A mutual fund, you know what the fund is in. Now, that mix can change, of course, while you're invested in it, but it's not a completely empty blind pool. And so there's reporting and whatnot. I'm probably getting further along with the question, but directionally, that's how the raised, from your point, goes. It's drawn down over 5 years. After 5 years, I can't, even if I've only invested $400,000 of your $500,000, and again, it's just done in pro rata slices, I cannot call the money after 5 years. And then we have 5 more years to exit the portfolio. It's a fund that has a 10-year life.
Okay.
In usual terms.
All right. So if someone says, gee whiz, Mike, that sounds like the wild, wild west. I understand, at least I understand the concept of how mutual funds are overseen in securities acts and whatnot. But you guys, yikes. How do I know that my PE guy is not Ponzi scheming me? How does that work?
That's a good way to put it. That's the most drastic adverse consequence ever. And so the biggest way is all funds are audited. I mean, our fund is audited by BDO. All of our funds are audited by, ironically, BDO. So they get a quick commercial here. So having audits and being able to check the math is really the most important thing. I mean, and I've never thought of it this way or answered this question this way, but if, for the fund that you're invested in, we drew down 10% of your capital. And so, that you've got $50,000 on your capital account, that 10% draw that's in there. And then you can see that in your capital account statement at the end of the year. And then you have the audit to back check to say, okay, yeah, these are audited. They audit all the financials and everything is there as it should be. The company is in the valuation. So, I mean, there's a lot of rigid protocols around these investment pools. So it's not the wild, wild west.
All right. And so if somebody the advantage of this is a new asset class, which is basically non-publicly traded smaller companies, I guess we might be able to say, if we can go that far with it, that are perhaps more nimble. You're in this situation, they're more local, so essentially there might be more knowledge or understanding of it or the environment they're in. But there is, you certainly invest in a smaller company if you want that's not publicly traded, but at least this way, it's bundled by people that have done their due diligence, laying out the timeline and expectations. Is that pretty accurate? I guess the advantage would be, in other words, if you want to be in the space of a non-publicly traded company, probably many of which are even family owned or have been, is that a good way to, it's like a mutual fund for a non-publicly traded company, so to speak. Now, again, that is, somebody's going to hold me to task for that and say, well, that's not what it is. And I know. But
I don't disagree. What you're saying directionally is correct. I mean,
it's it's not a mutual fund, ladies and gentlemen. It's a basket of non-publicly traded funds that have been vetted out to whatever extent your group has done that, so that you can participate in that, spread out some of the risk by, I guess, diversification, at least in holding, if not class, and participate in some of that.
And so you could participate in the growth of that business down the street that just went out and launched, built a whole new manufacturing facility because they're growing hand over fist. And there is the upside shows that there is upside there. There's an arbitrage between what a traded valuation might be for a private company versus a public company. And public companies usually are valued at a higher multiple, whether it's PE, which is the public way to say it, or say an EBITDA multiple that we would kind of look at on the private side. So there is an arbitrage to what could happen there if the company went public, is the most glaring, obvious leap that could be made. Our businesses that we invest in are small enough they're usually not going to be going public, but the concept is still there's upside, there's definitely value to be found, alpha for lack of a better term, and it actually is proven out. I mean, I don't have my hands on any studies right now, but over the course of time, it can ebb and flow, but different benchmarks for the public and private markets will show the private market definitely can outperform the publics in a variety of different ways over time. So, and that's part of why it can be attractive if you've got the right opportunities and the right funds.
And with the philosophy that you all follow, what would you say would be the average amount of funds? One fund, what's the average amount of companies that are in that fund that you've bundled?
I would say usually anywhere from probably 10 to 20 companies. A reason I gave you a big range there is because sometimes if it's a private equity fund, it's going to be more concentrated, maybe on, say, call it, 10 companies, 10 to 15 companies. If it's a private credit and mezz fund like we are, we might be more like 15 to 20 companies. If it's a venture fund that's VC checks, smaller companies, smaller checks, making more investments, might be in the 15 to 20, 25 range. So there's kind of a range of how, and it's a function of concentration. It's a function of how they're diversifying their.
All right, so I'm Joe Investor here, and I want to sell all my VOO and throw it into private equity. And you, of course, would say, don't do that. So how does someone consider, or what I should say, what are some of the considerations that should be met before someone like ventures into this? I mean, is there a ratio? Is there, how does one make an intelligent decision and not just a gut level decision?
So I'm not the ratio person to ask that. I mean, you can look at things where there have been like the Yale method where their endowment famously increased the amount of allocation they had to private equity back in the 90s, and it served them incredibly well. And then a number of endowments in university followed suit. And so I don't have an exact, what that ratio is. The year, or what is it? What do they say? Your age in bonds or something?
Yeah, right. Yeah.
Obviously, private equity for the most part should be on the equity side of that mix versus the bond mix, unless it's in sort of it's a private credit fund that has mostly senior debt in it and it's secured. It's not going to return as well, but it actually might beat out some of the bond, the bond funds that are out there that are on the public side. So it's definitely part of that equity mix. It also is a function of kind of liquidity. So, I mean, these are longer term funds. I mean, we will go fundraise and talk to some people and they will simply say, I'm getting up there in years and I just don't think that, having a 10-year fund is something that I want to be jumping into right now. So it's basically that time horizon as well as just kind of the drawdown path. So, I mean, if you're making $1 million commitment, you should be comfortable with excess cash checks coming out of $100,000, for the next, $200,000 over the next 5 years to meet that commitment. I don't know if I can answer that question as directly.
Well, we are certainly skirting around compliance with this entire conversation. So, ladies and gentlemen, we are talking in great generalities here on purpose, but I'm trying to bring some clarity for what's known to what's unknown and try to make some comparisons in general. So, okay, so you guys are the strength, of course, is looking at regional companies that you can get in your car and go talk to. There are PE firms, of course, that will be international, probably. And there's probably pros and cons to either approach, I would expect. But how many folks are involved with the investment team over there right now?
Our side or where's over there?
Your side.
Oh, yeah. So we are a team of just a handful of individuals. We share, overall, Charter's got roughly, call it 20 employees. We have a handful of employees that we split between both sides of the house. So to your point, compliance, controller, our CFO, business development, marketing, just administrative, kind of, make sure the trains are on time around here. And then on the Charter Growth side, there's 4 partners that sit on the investment committee, myself, my 2 partners, John and Hector, and then Mike Brown, who also runs the M&A advisory side, also sits on our investment committee. And then below that, there's 2 vice presidents that basically make sure that we've got to handle all of the investments that we're looking at. And then we've got an associate and then an analyst that we're to. But we share some of those junior analyst associate resources we share between both the investment bank and the Charter Growth side.
Okay. So in the investment side of this, as you're putting together a new offering and you're working on that, it's very difficult in the commercial space to sit down with the mutual fund managers and say, I'm thinking about investing. Let's have a conversation. It doesn't work that way. Do they have access to you?
Absolutely.
Okay, that's a big difference, ladies and gentlemen, right there. So they could buy a cup of coffee and pick your brain and talk directly to, I guess, the investment manager in the macro sense we're talking about here. That's not common in the commercial space, I would say.
If they're an LP in the fund, I'll buy the coffee.
Well, there you go. I wish I'd have known that a month ago.
we're always surprised at how quiet sometimes our investors are. They get quarterly reports. They're not as burdensome maybe as some public, mutual fund reports where you're not really sure what's what. It's pretty clear. The companies are very clearly stated in there. We show performance, we show our hopes, what our thesis is, all those kinds of things. But to your point, some of them are West Michigan based businesses that you can see, feel, and touch and have an understanding of.
Okay, very good. Well, this sounds. Diversification is a lovely thing. There are a lot of ways to do it, but PE is certainly, again, an option for folks. A lot of people don't realize it exists or haven't wrapped their brain around how it might function. Are there any other, resources or thoughts you might give us as somebody's considering entering into PE as part of their investment portfolio? Is there anything you want to add to this conversation as far as boot camp for PE?
I think the most important thing that you look at would be when you're talking to a private equity fund or a manager, a GP, again, as you would say, would be what their strategy is. Again, is it a venture fund, a private equity fund? Are they doing buyout investing? Are they doing real estate investing? Are they just making loans, credit type investments? That's the strategy piece. The next piece would be the team. Who is the team? Joe, Jane, Phil, and Roberta. Do you know them? How do you know them? What is their background? How long have they worked together? Did they go to college together and work at have they been around each other for 10 years or longer? Or did they just meet at a coffee shop down the street 2 months ago?
And opened up the back of their trunk and said, hey, let's do something.
We should do something.
We could raise capital.
And, ambition is great, but, execution matters. And so that's why the last would be track record. Is what is the track record of this team? Just like you look at, and I have no idea what I'm doing when I look at the public mutual funds and I'm tracking I'm like, I don't know, this looks pretty good, but you should have an understanding for what the track record is. How have they performed whether it's at their previous firms or previous funds, or that all as a team, how they've performed in their earlier funds. How do you feel? Do you have clients that reach out to you and talk to you about private equity or with a question mark of like, what do I know? Or, Chris, what do you know about this? And are those conversations that are happening more often?
There is a mystery to it. We've had several conversations with some of our clients about it, but primarily not much. Most people are staying in that known quantity. And so that's what I was discussing before. And I know you can't advise on this, but depending on the size of your portfolio and what kind of a percentage you could put in something like this, again, it's a diversification that is pretty much unavailable to you in mutual fund, ETFs, et cetera, because this is not publicly traded equity, and that sliver could have a really powerful part within your portfolio. Of course, you have to work with your advisor, your professional teams, your CPAs, maybe even your attorneys as you have conversation if you have big bucks to invest in something like this. But it certainly is, that's what I was going to ask you, is this a growing field? Is this becoming a more popular thing, or is it still kind of a nuanced offering in the world of investing?
No, it's definitely becoming more and more popular. We're seeing it, real time, even before the last, year or so, with the asset class growing significantly, whether it's real estate or private equity or venture or whatnot. And then now the concept that individuals might have access to their 401ks or IRAs to allocate into different private equity vehicles is a new thing as well. That's really going to bring a lot of assets into the asset class. And see significant growth.
Yeah, it certainly would. If institutional investors are starting to knock on your door, I would imagine that would be a boondoggle for PE. Yeah, for sure.
Yeah, and for better or worse,
yes.
We will see how that works in the asset class, because it will be a lot of capital that will start flowing in. It really won't impact us at Charter growth. We don't have access to those huge conduits of capital that are set up to have to, again, your point, the compliance to run with the larger kind of allocators that are out there. We will see what it does. But there's definitely been more of a conversation and more interest in it that's driving all this.
Yeah, very good. Well, Mike, we're going to be putting up some contact information, how folks can get a hold of you and Charter Capital, either for the advisory part of this or the investing part of this. And ladies and gentlemen, they will pick up the phone if you call them. They really will. And they're good folks over there. Any closing remarks that you might have for us at all? Or
No, I appreciate the time. Always happy to chat about this. And to my earlier point, always trying to demystify private equity a little bit more every day.
Yeah. Well, that's great. I imagine that's a major part of what you do. People start kicking your tires. But don't be afraid of the opportunity, ladies and gentlemen. There could be, you don't know what you don't know. So this is certainly a mainstream asset investment class, I would say, at this point in time. And it gives you opportunities to connect with non-publicly traded companies and do so in bundles rather than just onesie-twosie. So that also gives you more diversification and stability, I guess. But yeah, I thank you very much, Mike. This has been great. Thanks for letting me ask you some of these questions and peppering you with issues. So appreciate you very much.
Thank you for joining us for today's episode of Navigating Abundance. If you found this information useful or helpful in any way, let us know in the comment section below. If you'd like to see more content like this and follow our podcast, you can find us on all major podcast platforms. If you're interested in working with today's guests, you can find their information in the description of this podcast. If you'd like to know more about Navigating Abundance and how we may help you or find more resources related to what we do, you can find those at navigatingabundance.com.